So a year ago around this time, I put out a video on inflation and talked about using Treasury inflation protected securities, or more commonly referred to as TIPS, as one way to hedge against it. In that video, I also talked about traditional bonds in general and how they differed from TIPS. Today I'm going to talk more about bonds, this time specifically Series I bonds as another way to hedge against inflation. I'll tell you what they are, why you might consider them, and maybe reasons why you shouldn't. Plus, if you feel they're right for you, I'll tell you how you can get them. It's a little more limited than with other types of investments. But real quick, I want to first welcome you to Healthy, Wealthy, and Wise. We're talking about our financial wellness and how to achieve it is my top focus. My name is Kevin, and on this channel, I share my experiences and the strategies I've used in my over 25 years of DIY investing. And now that we're having the highest levels of inflation that I've seen in my adult life, talking about inflation hedges makes sense. As I talked about inflation last spring in the TIPS video, I mentioned how the Federal Reserve rate was essentially at 0% at the time and that eventually the rates would begin to rise to tamp down inflation, which was already starting up. Well, it really ramped up, and now after the highest rates of inflation in 40 years, that cycle of rate hikes has begun this year. And with interest rates already going up with more to come, the era of cheap financing and loans is over. And this higher interest rate environment has been a huge factor in pushing the overall stock market down, hammering those highly leveraged growth stocks particularly hard, resulting in many of us having seen our stock funds drop significantly in value since the beginning of the year. So with all the major stock indices down, with more rate hikes on the way that will only keep pressuring stock prices, everyone's asking where can they safely put their money. The one thing we should realize is that a basic bank savings account isn't really all that safe in an inflationary period. Yes, your principal is protected, which there's something to be said for that if you'll be needing your money soon. However, the reason that a bank savings account is not really all that safe is that the interest you're paid by the bank on your money is still very low. In fact, well below the rate of inflation. And that's important to consider because inflation erodes our purchasing power, meaning that what we can buy for $100 today might cost $110 or more next year, and yet the interest you receive for keeping your $100 in the bank for that entire year might only net you about 50 cents or so. So even though your principal is safe, the purchasing power of it goes down, so in a way you're losing money. Put another way, your money is basically becoming less valuable because it's not keeping up with the rate of inflation, which means that the cost increases on things you buy is going up faster than your money is growing in a bank account because the interest rate is so low. So what can you do with your money to help it grow at a level that matches inflation? Well, TIPS is one option. As I said at the beginning of this video, we've already talked about them on this channel in another video, so if you missed it, you might want to check that one out. I'll link it for you in the description. Another option in the focus of this video is investing in Series I bonds, or just I bonds. I bonds are inflation-adjusted U.S. savings bonds. As the name implies, an I bond is designed to have a rate that adjusts by either increasing or decreasing along with the rate of inflation. How it works, to keep it simple, is that the I bond actually has two rate components. One component that is fixed and another one that is variable. Let's talk about the fixed component first. The fixed rate component of an I bond stays the same over the length of the bond, which is for the entire 30 years that interest can accrue on it after it's issued. This rate is unsurprisingly pretty low, but you might be surprised to know it's actually been at 0% for the past 2 years. Needless to say, nobody is buying an I bond at this time based on the fixed rate of 0% over the next 30 years. It's the second variable rate component that is drawing all the interest in I bonds right now. This is called the inflation rate of the bond. The inflation rate is updated every 6 months based on changes in the non-seasonally adjusted CPI, which stands for the Consumer Price Index for all urban consumers for all items, and this measure includes food and energy. This update to the inflation rate occurs 2 times per year, on the first business day of May and on the first business day of November. When we are in an inflationary period, as we currently are in now, the inflation rate of the bond is positive, meaning you accrue interest. Now in periods of deflation, where prices are dropping and the CPI is negative, the Treasury limits the combined rates of the bond to 0, so you don't have to worry about a situation where you're losing money by holding the bond. You just won't be earning any. So as of this recording, we're now in May of 2022, and the semi-annual inflation rate was just recently set at 4.81%. And the formula for calculating the composite rate, or the combination of the fixed and variable rates, is the fixed rate plus 2 times the semi-annual inflation rate plus the fixed rate times the semi-annual inflation rate. So using that math, which is 0 plus 2 times 0.0481 plus 0 times 0.0481, the composite rate comes to 9.62%. That means that any I-bond bought within this time period, May through the end of October, will have interest accrued at this rate monthly. Now what's important to know here is that if you bought an I-bond at any time during this time period, your I-bond will pay you at that rate for the next 6 months, whether you bought it in May when the new rate took effect, or even if you bought it in October at the end of the period. After those 6 months, you will then accrue interest at the new rate set in November for the next 6 months. Again, that's not necessarily when you'll receive that rate. It will be 6 months after you bought the bond. So if you bought the I-bond in October, you would accrue interest at the current rate for the next 6 months, and only after that would the most recent update to the rate in November take effect. This might seem a little confusing, so definitely rewind and review this to make sure you understand. Also, keep in mind that the interest is compounded semi-annually. So every 6 months from the bond's issue date, the interest the bond earned in the 6 previous months is added to the bond's principal value, creating a new principal value. Interest at the updated rate is then earned on the new principal. The interest and principal are paid to you only when you cash in the bond. So let's take a step back and think about this composite rate of 9.62%. If you currently have an I-bond, or if you buy one at any time between May and the end of October in 2022, you are guaranteed to receive monthly interest of 9.62% for 6 months. Let's say that again, 9.62% on a US bond, a bond that is backed by the full faith and credit of the United States government that up to this period in time, the US government has never defaulted on its debt, which makes it about as safe as you can get. Now consider what your bank savings account rate is, what CDs are paying, what money markets are paying. Nowhere near 9.62%, right? Now in a good year, stocks can definitely beat that rate, but the question we have to ask ourselves is, do we think the market will do that this year? It's often said, and very true, that it's really hard to predict how the stock market will perform in the future, particularly during shorter time horizons such as 12 months. It could go up or it could go down. Having said that, with the headwinds of more interest rate hikes coming and inflationary pressures on companies' expenses and the overall economy in general, there's a lot of sentiment that the market might be flat at best in the upcoming year. In this situation, you have to ask yourself, do you take the chance on the uncertainty of the market versus a guaranteed 9.62% interest over 6 months? The guaranteed 9.62% sounds very tempting in this current economic climate, doesn't it? Well, before you move forward in buying an I-bond, which I'll tell you how to do in a minute, I do want you to be aware of a couple of reasons that may make you want to think twice before jumping in. Probably the biggest reason to consider not investing in an I-bond is that once you buy one, you can't cash it in for at least 12 months. There's just no way around it. So if you were to need that money, you won't be able to access it for a full year. Because of this, an I-bond is not where you would want to put your emergency funds or money you may need within the next year. Now after a year passes, you can sell it anytime afterwards, but something else to keep in mind is if you cash it in before holding it for less than 5 years, you would have to forfeit the last 3 months of interest, so that's an important consideration as well. Now after 5 years, there is no penalty where you have to forfeit any interest when you cash the bond in. To me, losing that last 3 months of interest by cashing in after holding it under 5 years is a lesser problem, particularly if you're getting a much better rate than you could elsewhere over the course of a year. But again, the bigger issue is if you need that money within the first 12 months of buying the I-bond, you just can't get to it. The other big consideration is if you buy the I-bond now, from May through October, you're only guaranteed to get that 9.62% interest rate for 6 months. But as I just said, you have to hold the I-bond for at least a year. Once again, that rate sounds good, right? Well, that's only because inflation is high right now, but there's no guarantee that the interest rate will stay that high when the rate is reset in November. In fact, as the Fed continues to hike the Federal Reserve rate throughout the summer, it's likely to start slowing the rate of inflation, which would mean that the variable inflation rate component of the I-bond will be lower than it is now, leading to lower interest that will be accrued. And to that point, Many analysts and economists believe that this might be the peak of inflation. So if that's the case and the inflation rate is reset lower in November, your money is no longer making 9.62%. Now in a completely hypothetical worst-case scenario, let's say that the inflation rate drops to 0% or even if it goes negative where deflation occurs. Even if that were to happen, you still would have a 4.81% return for the 12 months, which would still be better than any interest-bearing bank savings account. Of course, the main issue being that you don't have access to move your money into something else within those 12 months. Another thing to consider is that in a calendar year, you are limited to investing up to $10,000. In most cases. I'll tell you what I mean by that in a minute. Now if you're married, your spouse can also invest up to $10,000, so a couple could invest up to $20,000, $10,000 per person. Now $10,000 is nothing to sneeze at, but if you're someone that has a fairly substantial amount of savings, this just means that I-bonds won't be able to fully hedge your investing capital against inflation. So let's say you have $200,000 in brokerage or bank accounts. You would only be able to park $10,000 of that, or 5% of your portfolio, in I-bonds. So you're just limited in how much of your capital you can hedge against inflation using I-bonds. That doesn't mean you shouldn't consider it, but just to realize it's not the answer for fully protecting your money. Now, as I alluded to a second ago, there is one other way to buy additional I-bonds over that $10,000 limit. But that can only occur if you have an income tax refund where you can request up to $5,000 in paper I-bonds. Otherwise, you're limited up to $10,000 in I-bonds, and those can only be purchased electronically. And unlike other types of investments such as TIPS where you can buy them from banks and brokers on the secondary market, you can only buy Series I bonds directly from the U.S. Treasury at the Treasury Direct website, which is at www.treasurydirect.gov. Because the bonds are electronic, you have to open up an account at Treasury Direct where your bonds will be held. You'll also have to link a bank account where you can transfer your funds back and forth. Setting up the account isn't difficult, but it is another account that you have to keep track of, and I know a lot of people like to keep all of their savings and investments in one place. As far as how much you can buy them for, you can buy them starting at a minimum of $25 up to the annual limit of $10,000. So let's say you decided to buy an I-bond. What does that mean for taxes? Well, first of all, the income earned is taxable on your federal return. However, it is not taxable for your state and local tax returns. Although you can choose to report your interest income every year, the majority of people defer reporting the interest until the year they cash in the bond. I think this is a good time to remind you that while my videos are meant to be informative, they should not be seen as a recommendation for you to take any action based on the information or the personal opinions I share. You should always do your own research or consult with your own financial advisor when making any investment decision, and considering taxes is a big part of that and how it relates to your individual situation. So I think that about covers the basics on Series I bonds. What do you think? Are they something that you're going to consider? Or do you have another strategy to hedge against inflation? Let us know in the comments. We're always looking to learn from each other here. I hope you enjoyed the video, and if you did, please press that like button and share with your friends and on any of your social media sites and forums you're on to help spread the information. And if you're new to the channel or just an occasional visitor, we'd love to have you join the community. You just got to press that little red subscribe button. We'd love to have you on board. Until next time, thank you for watching and have a great day.